Hi, everybody. It's Jose Luis Morales with the Morales Real Estate Group. Welcome back to the Jose Luis Morales Show. This is episode number 19th. Today, we've got a very special guest. We have Jason Ritchie here coming to us from Mission Bank, and he's going to be educating us on commercial lending. So for those of you that don't know, there is a difference in residential financing and commercial financing. So the reason I wanted to bring Jason on is because he's a commercial lending specialist, and I wanted to share some of those differences for you. For those of you watching, it is important if you're a business owner and you've ever thought about buying your own business, if you've ever thought about buying apartment complexes, 4 units or more, if you've ever thought about buying acreage, like for example, like farmland or something that produces income, then Jason would be a great resource. So welcome to the show, Jason. How are you?
I'm doing great, man. Thanks for having me. I'm excited to do this. Hopefully I can shed some knowledge on some folks.
Yeah, no, I absolutely believe so. So good. So let's just start off. What is a commercial loan? I don't know if you know the difference of how it relates to residential, but what is a commercial loan essentially?
Yeah, so a commercial loan, I mean, in the simplest terms, it's a mortgage secured by a lien on a commercial property, right? Mm-hmm. And what makes the difference between a commercial property is really the use. So if it's income producing or if it's for investment purposes or business purposes, that's kind of what makes it a commercial property and then therefore a commercial loan. So that could be really, generally speaking, 1 to 4 is considered residential, and anything beyond that and anything other than that is commercial property. But I've even done commercial loans on the 1 to 4 because of the use. So and also as well, if it's a business that's buying or doing something with a 1 to 4, it makes it a commercial loan as well, as opposed to an individual. So that's in summary, I should say, that's a commercial loan.
Okay. And I had never heard of, or not heard, but typically most commercial lenders focus on over 4 units. What is an example of a case that you did a commercial loan on a 1 to 4, if you don't mind sharing that?
In most cases, it's who the borrower is. So if you as an individual said, hey, I want to buy this triplex in Ventura, you're probably better off going to a regular residential mortgage lender. Mm-hmm. But if you and a group of 3 buddies wanted to form an LLC and invest in a triplex or flip a home, that's when it starts to become a commercial property. So you can't have that LLC or business classification and then still qualify for residential mortgage.
Okay, great. I think that's important to know. Great. Now, what are the different types of commercial loan products out there available to consumers?
Yeah, so there's hundreds probably. There's a lot. So it depends on what your use is really. But there's I've done loans for folks trying to buy an office condo for themselves, multi-tenant office building for themselves. Also, I've on the flip side of that, just investors that want to buy that space and then rent it out to the business owner across the street as well. So regular purchase financing we've done. And then on the flip side of that, if you are buying something for yourself, you qualify potentially for an SBA loan, which an SBA loan, while it's more paperwork and probably takes a little bit more time, has some advantages to it because you can either do a lower down payment or stronger credit structure or more favorable credit structure. So that's in regards to purchase, there's that right there. But then we also do a lot of development loans. So to buy and build some retail strip centers, to buy and build industrial warehouse space, all kinds of stuff like that. There's also bridge loans / construction loans where you buy a piece of property and you're maybe not quite ready, because normally under construction loan circumstances, we want to have all the pre-approval stuff done. So all the permits and everything is ready to go. Plans are approved. So, but if that's not the case today, but you kind of need to get from point A to point B to that, to where you've got all the permits and you're ready to put a shovel in the ground, we can do bridge financing on that piece of dirt or whatever's there now to kind of get you to that space. And then once you're ready to start building, do construction loan from there. One other one that I don't know if it's very common, but we do a lot of too, is lines of credit, just real estate secured line of credit. So I have a lot of customers that have come to me and said, hey, I've got this free and clear property over in Ventura, a lot of equity in it, but I'm kind of short on cash. Can you just give me a line of credit secured by this property so that I have access to capital and can go buy deals as they pop up and I can move quickly versus having to apply? Because you know just as well as anybody, I'm sure that being ready with the funds in hand can win you some deals.
Yeah, I think that's one of the ways that people can get good opportunities. Are those lines of credit, Jason, mainly on primary, or are those on secondary properties like investment properties as well too?
Usually in my space, the commercial space, it's usually the investment properties or the secondary homes, or if you have a free and clear commercial property, you know, office building or something like that. Most of the time, it's not going to be on your primary residence because you'll probably get better terms from a mortgage lender that does home equity lines of credit
on primary residences. Okay.
Yeah.
What are the debt, not the debt to income ratio, the loan to value ratio, for example, on a investment property? And I asked is I have rental properties myself, and I've always thought about something like this, just like you said, just to have the money ready, and then if something good comes up, I can pull the trigger. How much am I allowed to borrow based on the value that the property or the asset is worth?
For that line of credit product, usually about 50% is where we want it. That's kind of our sweet spot. You know, if you really wanted to stretch, we could probably go up to 60%, but usually that's kind of the starting point for me is 50% on those lines of credit.
Okay. So essentially, if you have a property that's worth $500,000, that property's paid off, you could essentially have a credit line of about $250,000, which is 50% of that. And then you can use that money at your disposal for however long you want.
Yeah, exactly. In that line of credit what we usually do in those situations is using the $250,000 example. You use that $250,000 to go buy something because you needed access to funds to kind of win that property. You buy it, and then now you've got all the time in the world in theory. So now you can then apply for a loan, and that loan will pay down the balance on that line of credit. So take that line of credit balance down to zero again. So now you've got the property that you wanted to buy with a mortgage against it, and then you've got that full $250,000 of availability on that line of credit again.
Yeah, and the great thing about doing that is sometimes people imagine that they have to sell a property in order to get the money out. But if you sell an investment property, then you may be subject to potential capital gains or some sort of tax, as opposed to that if you just use the money that is already in the property by obtaining this type of product. It allows you to use that money and then kind of do the same thing, maybe fix it up, rent it, refinance, and then you have all your money back. So it's really a good opportunity. I think where a lot of people aren't aware of, and I've come across this because I work with a lot of lawyers, I work with doctors, I work with professionals, and a lot of them never own their own building. And I don't think that a lot of people are aware that there is an SBA product, essentially, that if they wanted to, they can buy a commercial property with minimal down payment, essentially own it, and then someday be done paying it off. Not only that, but sometimes investors sell the building and need the property vacated. I've had situations like that as well too. So what type of down payment would somebody need for an SBA loan? And also, can they buy more than one unit with an SBA loan? Can they essentially use one of the units, maybe rent out another unit? What's the general rule with that?
Yeah, so there's a couple different products that the SBA offers, but the main one for real estate purchases is called a 504, and essentially allows up to 90% of the purchase price. Wow. So that means a 10% down payment, which makes a big difference because you're right. A lot of business owners that I talk to as well kind of like the idea of buying their own property, but the idea of coming up with 30% down in cash, a lot of times that money can be used in their own business rather than kind of being tied into a piece of property. So this dropping that from 30 to 10 makes a big difference for a lot of people. So in the way that loan is structured, it's kind of an odd one, and I'll try to be brief about it, but it's essentially two loans. So the bank that you're dealing with, so I work for Mission Bank. Mission Bank essentially offers you a 50% purchase price loan, and then the SBA comes in and does a 40% loan behind it. So it's a total of 90, but two separate loans. So the bank's happy because they've got a 50% loan to value. The business owner's happy because they've got, you know, a property that they only had to put 10% down on. And there's all kinds of advantages to owning your own space. So in regards to multiple units, the answer is yes. The rule of thumb, the only requirement that I'm aware of that the SBA has is you as the property owner has to occupy 51% of the space. So it has to be just 1% more owner occupied than not owner occupied. That makes sense. As far as I know, that's the only requirement on units.
So essentially, it could be 3 units as long as you had the larger percentage of the property being occupied. And
Exactly.
like I said, I mean, it makes a big difference going from 90% loan to value to 70% loan to value. I mean, that's a difference on a $500,000 property, $50,000 versus $150,000, which obviously makes a tremendous difference. So I want to encourage those business owners out there that if you're renting a building and you've been renting for a long period of time, talk to somebody like Jason. Maybe doesn't have to be Jason, but just know that there are products out there for you that could benefit you from a financial perspective in the long run. Because I mean, it leads to eventually owning your own building. Now, these type of loans, like an SBA loan, like I know for residential, Jason, you're typically getting 30-year fixed rates. Is that something similar on an SBA? And how does that vary from maybe like an SBA versus an investment product? Are they fixed for 30 years? Are they fixed for a certain period of time? Are they amortized for the same amount of time? Tell us more about that.
Yeah, so that's the one glaring difference between residential loans and commercial loans. So generally speaking, and every bank will be a little bit different. So because every bank, depending on their size, depending on their overall model, may have different philosophies for how they want to structure credits. And it can even vary depending on the borrower. If there's a really strong borrower versus one that's kind of on the fence, that can change the way we structure. But generally speaking, it's a 10-year loan on a commercial property, but the payments are amortized over 25 years. So what that essentially means is the payments are on a schedule as if it were a 25-year loan, but in year 10, technically the whole entire loan unpaid principal balance is due. Now, usually what happens in that case, and it's why you should have a good relationship with whoever you're getting the loan from, is there's communication going on basically past year 5, but between year 5 and year 10 about, hey, what's going on in the market? Are rates up or down? How are things looking? Because we're going to, at the end of year 10, we're going to need to do something, and we may want to refinance it when the opportunity is at its best. So like I said, it can vary. Those amortizations can vary between 20 and 30 years, depending on the bank, depending on the customer. But most of the time, more often than not, you're having a 25-year amortization and a 10-year loan. Now, with the SBA loan, you know, I mentioned to you it was 2 loans. So the first 50% that the bank finances, it'll have that same 25 due and 10 structure. But the second portion of the loan, the SBA covers, that's a 25-year fully amortized loan, which means the payments are on a 25-year schedule and the loan doesn't mature for 25 years. So at least on that second 40%, you've got some space and don't have to worry about it for, you know, almost 3 decades.
What about now?
You're back.
I'm back. Yeah, I saw that my face froze for some reason. And I heard everything that you were saying, but for some reason it didn't go through. So I hope that the viewers didn't lose what you were, but it looks like my face froze again. Can you hear me?
Yeah, I can hear you.
Okay, perfect. So essentially what I was saying is that for an SBA, there's a lot of benefits for the end user, not only on the fact that it's amortized, at least from the SBA, and that's new to me. I didn't know that there was 2 different loans, so that's kind of cool how it works out that way. Now, as it compares to residential loans, how are rates on a commercial loan versus a residential loan? Are they pretty comparable?
Yeah, the commercial rates will generally be a little bit higher.
Mhm.
They've been ticking down lately, but I would say ballpark, what we tie it to is the treasury rates. So the
Mhm.
5, 7, 10-year treasury rates, and then we'll add a spread to that. And it's
Mhm.
usually a spread of the treasury rate plus, 3%, let's just say. Every bank's going to be a little bit different for where they kind of start that. And then from there, there's wiggle room in either direction, depending on, hey, this is a really good borrower. The loan to value is really, really low. There's all these kind of good factors going on here. So we can drop that spread a little bit to kind of keep the rate lower, or vice versa. If it's kind of the opposite scenario, then it can tick up from there. But usually every bank will have their own philosophy on take the treasury rate, add a spread to it. Today, I would say you're probably in the 5.25 to 5.75 range on a commercial real estate loan.
Are there exceptions? Because I've heard a couple times, depending on the strength of the borrower,
Mhm.
like for residential, I mean, there's a box. You either fit in it or you don't, because a lot of the loans get sold to Fannie Mae or Freddie Mac. It sounds like there's a little bit more wiggle room on a commercial loan and a little bit based on the relationship that you have with the bank as well, too, because it sounds like if you have the right relationship with your banker and the right relationship with the bank, there may be certain exceptions that could happen, as opposed to maybe having to put 30% down. If the deal is right, they may allow you to put a lower down payment. Is that true in commercial lending?
Yeah, you hit the nail on the head. Most of the time, commercial it's a lot more relationship based. Now, there's all kinds of relationships with residential mortgage lenders too, um, but for commercial loans, particularly the bank that I work for, um, the relationship is extremely important. The deposit relationship in particular is extremely important. So if you're a guy that I've known for a couple of years, done a couple of loans for, you've moved maybe not all your personal banking, but your business banking over to the bank that I work for, you're gonna have your negotiating power, I should say, is going to be a lot higher because you're a person that I trust. You're a person that's doing good for the bank just as well as I'm doing good for you and helping you buy the things that you want to buy. So for a person like that, that's kind of proven their ability to pay back the loan and also has some, other relationship factors. Yeah, there's a lot of wiggle room, which is what makes my job in particular kind of enjoyable because you get to really be a part of somebody that's growing in kind of play out in their 5-year plan, 10-year plan, and the more of a part you play in that, the easier it is for them to get. Easier is for me to get you what you want because I've seen it. I've been a part of what you're trying to do, and I know that this next purchase for you makes all the sense in the world. So getting what you need for you gets even easier.
So what I would recommend from a real estate perspective, and what I'm getting from this is, don't go to the bank. Don't wait till the day that you actually need the loan. If you're a business owner, don't wait till the day that the owner of the building says, hey, I want to sell the loan. You've got 15 days to get this loan. Begin establishing a relationship with a bank sooner than that. And I would even say go to the extent of doing it now. But what I typically do is way before I actually need the loan, I know what I have to do. I've talked to the right people already, and I have an idea of what I have to do. That way, when the right opportunity presents itself, you've already got a step ahead. So for example, if you're looking or you've got a goal to eventually buy your own building, even if you're 3 years away, even if you're 5 years away, begin building a relationship with either Mission Bank or another bank that you feel comfortable with, and begin building that relationship and let them know your goals, and they'll let you know what you have to do to be able to accomplish that. So when it does come time, they already know who you are, they've got your information, and they're more likely to be able to help you out in that situation. So that's what I would recommend. The other thing is for aside from the SBA product, you guys have multi-unit apartment complex loans. You guys have land development, all kinds of different products. What is the typical down payment for something like that? Is it 30% or does it vary based on the product?
It'll vary based on the product. I would say general rule of thumb is 30% down.
Mm-hmm.
So the land loans, if you're just buying a straight land loan, it's usually 50%. Yeah. So if it's just, and that's because it's not income producing, and those are usually the bridge type of loans. Usually, if I'm going to lend money on a piece of dirt, it's because you've got a plan to eventually put something on that dirt in the next 18 to 24 months. So it's going to be like a 50% interest only type of loan on that. But for most income producing real estate assets, it's usually 30% down. We're kind of looking for that 70% loan to value, loan to cost situation.
Let's say that somebody finds a smoking deal where it's just like an apartment complex that produces a lot of cash flow and they're just able to get a great price. Is there such thing for the right borrower with the right relation where they can buy that with like 10% down or 5% down? Or is it like the lowest, probably like a good 20, 25, maybe 30%?
Yeah, it depends on how smoking that deal is. So we always want to have the borrower's got to have some type of skin in the game. So there are situations where I've had customers of mine that are able to find a deal that when we appraise the property, the appraised value of the property is like twice what they ended up buying it for. So those obviously don't come every day, but that same conversation or the same question that you're asking me now comes up, right? Is, hey, look at how much equity you've got in this property. Why can't I get a little bit more than normal? And so generally speaking, 80% loan to cost is kind of where we want to keep it. There are situations, I try to treat everything case by case, depending on who it is in the situation. But generally speaking, we don't want to go above 80% loan to cost. So you may find this smoking deal and you got you paid half of what it's worth. So we're at a 50% loan to value, but we don't want to exceed that 80% loan to cost in most situations, because it just ensures that there's a little bit of skin in the game by the borrower. And if they've got a little bit of skin in the game, they're more likely to take it a little bit more seriously and make sure that they take good care of it. Plus values can go up and down. So it's just a little bit of extra.
Let me ask you a question. What if they purchase something, and this is just a situational, what if they purchase it at 80% and then a year later they appraise it and the value has gone up? Could they essentially restructure the loan at that time and take a good portion of their money out, hypothetically, if they either improve the value of the building? And is there a certain time that you guys like to see before that something like that does happen?
Yeah, usually 12 months. So that scenario that you're talking about, we've done that a few times as well. It's particularly when, as you mentioned, they buy it, put a little bit of money into it. That money that they put into it is kind of factored into that total cost, right? So that increases our threshold for that 80% loan to cost, one, but also they've owned it for 12 months. We know that the value is there. We know that it's income producing because we can see it. We've seen the income come in on that property and cover the loan amount. So that gives us a little bit more room to increase the loan amount, pull some cash out.
Now, in residential, a lot of the valuations are based on comps, like what has sold around the area. I would imagine that for commercial, there's some of that. I've heard that the good thing about commercial is that it's also based on the income that the asset produces. Can you elaborate a little bit more about, from a lender's perspective, how you guys take into account the income that the property produces? Also, what I wanted to touch on is it also based on the strength of the borrower, or does it have more or less to do with the strength of the property as well too? Are they basing it more on the actual borrower, or are they basing like, man, this is just a great deal, like it produces tons of cash flow?
Yeah, it's for appraised value, it's usually more about the cash flow and the sales comp. So if I order a commercial appraisal, they'll usually give me two different values and then kind of reconcile their concluded value based on those two. The first one is the sales comp value. So similar to residential, although there's usually less inventory in commercial space than residential, but they'll do what they can to find as many comps as possible in the area and kind of move it up and down based on age and condition and all that stuff, and actual location, to come up with our sales comparison and market value. But then, as you alluded to, the income approach to value takes me as the appraiser. What do I think the market rents are on this property? So he'll do a similar survey as he did with the sales comps, but he'll do rental comps. What are other similar properties pulling in rent? and let me kind of use those to come up with an average or something that makes sense for this property based on the square footage and condition. And then also at the same time, he'll come up with his market expense estimates. So what are the market rents? So what is the gross income going to be on this? And let me take an estimate on what the person's going to pay in utilities and taxes and all that stuff to arrive at our net operating income.
Mm-hmm.
And then from there, essentially they arrive at what they call a capitalization rate. And that's based on, again, comps for what have other properties sold for in relation to the amount of income that they pull in. So
Mm-hmm.
you'll see capitalization rates vary based on location and based on type of property. Essentially, that's what they do. They take the net income and then divide it by the capitalization rate to come up with an income approach value.
Okay, cool. Now, in regards to qualifying for a commercial loan, can someone have a foreclosure on their record and qualify for a commercial loan? Can somebody have done a short sale and still qualify for a commercial loan? Are there certain guidelines on that sort of thing?
Yeah, so every bank will have a policy on this. So I've seen some, and I've dealt with some banks that say, if you've ever had one, we're just not going to do a loan for you, period. And then there's other banks that say, well, if it's beyond 10 years, then we'll look at it. If it's less than 10 years, either we won't do it, or it just has to go through extra steps in terms of underwriting and approval authority. So in most cases, it's that last option is what I see is okay, they've got this bankruptcy or this foreclosure or this short sale on their credits. When was it? What were the circumstances? And we kind of gather as much information on it, get as much information about the person so we can get to know them as much as possible. And then from there, if we decide, okay, this person we think is going to be a good borrower. Some stuff happened that was non-recurring. It's not like a regular thing. It's not something that this person's a bad person or anything like that. So we feel strongly about this person and this credit. So usually you'll have to go through what's called a loan committee at that point. So, sometimes even your board of directors will have to kind of weigh in on the decision. Yeah. So most of the time that's what it is. And then most banks will also have a policy of 10 years and beyond. We're not even going to worry about it because it's not even showing up on their credit report anymore. So that's another reason to your point that you made earlier of maybe thinking ahead of time, if you think you might buy something in 3 years, talking to your banker to figure out what their policy is on that, because it's something that you don't want to have to find out when you're scrambling to buy a property in the next 30 days. It's something that you've already kind of figured out and planned for, and maybe even waited to buy a property so it got past that 10-year threshold or whatever it is for that bank.
Yeah, that makes sense. Okay, good. Is there anything else, Jason, that you think that consumers should know as it relates to commercial loans that you think would be helpful?
So I would echo what you said. It's important to start building a relationship with whoever you think that lender might be, whether that's me or anybody else, depending on where you live. It's important to kind of get to know them. One, because depending on the size of the bank and the type of the bank, character is really important. Being able to kind of sit down with this person and say, I really trust this guy or this lady. So that actually carries a lot of weight with some lenders, is just being able to say, I like this person and I trust this person. That carries a lot of weight. And sometimes getting to that place takes a little bit of time. But also kind of building a business deposit relationship outside of that. Those things can be really important. And not only will it help you potentially get a loan approved, but it may, as we talked about, get you better terms because there's all these other factors that kind of go into it. So there's that. Start building a relationship. Get to know what they're looking for, and so you can plan for it. And then the other thing I'll mention too is there's a lot of benefits to if you're a business owner to owning the property that you're in, and they go beyond the scope of just not having to worry about what the landlord's going to do tomorrow or next month. There's a lot of tax advantages. There's even a lot of legal advantages, I believe, to owning your own space. I'm not an expert in those fields, so I'm not going to dive into it because I would be, drowning in the information. But talk to your CPA, talk to your attorney, because there are certainly advantages to owning your own space, and it's important for any business owner to understand what those are.